With us today is Wilmot George, Vice President of Tax, Retirement, and Estate Planning at CI Investments. Joining us also is Trevor Perry, tax lawyer, President of TRP Consulting. In announcing the changes, the government stated the following: "We are taking action to improve the fairness of the Canadian tax system by closing tax loopholes and amending existing rules to ensure that the richest Canadians pay their fair share of taxes and that people in similar circumstances pay similar amounts of tax." This came from the Department of Finance on July 18, 2017. Wilmot has been our point person along with Trevor Perry on these tax issues. So, Wilmot, who are the richest Canadians and how many of them are expected to be impacted by these changes?
From a tax perspective, David, there really is no formal definition for richest Canadians. However, the government has indicated that only 3% of all private corporations are benefiting from the income splitting and passive investing rules that are the subject of the changes. So the government appears to be targeting this group, and for passive investing rules, they appear to be targeting incorporated businesses who earn business income while also accumulating more than $50,000 of investment income in any given year.
And Trevor, when you're out, again, talking to clients in the field, how do you see them looking upon all these changes and really focusing on them specifically and trying to get more tax money from them?
Well, I think that they're fundamentally concerned. Even folks who would consider themselves to be longtime liberals believe that a 53% top tax rate, which occurs at $220,000 or more in this province, is outside of a period of war not morally justifiable. They feel that they have been targeted, and they have, by the federal government as some kind of class enemies, the hated 1%. And I would point out that the 1% in Canada occurs at somewhere around $190,000 of income. It's considerably higher in the United States. So they've engendered an unhealthy amount of class envy, and they're basing policy on it. And the folks who are at the sharp end of this, the doctors, the dentists, the business owners, our employers, feel affronted and are rightly taking steps, both in terms of planning and in terms of overall action to see this turned around.
We're also hearing that when you actually look at the income that's going to be passive income above the $50,000, you actually could be encroaching on a 70% income tax. Is that correct?
Well, you know, look, and this is part of the reason why business owners want to sit down with their investment advisor and talk about ways that they can keep their passive income. We call it aggregate adjusted aggregate investment income. You want to keep it below a certain amount or a certain threshold, and there are strategies that you can engage to do that. Okay, so you know, if you're running an active business and you have business income that's subject to tax at that reduced small business tax rate, but at the same time you're generating significant amounts of passive income, work with your tax advisor to ensure that you're taking advantage of strategies that will result in less reportable passive income so that you can preserve access to your small business tax rate.
I see. Government has targeted individuals who earn income in excess of $190,000 annually. This 1% is really the middle class today. Even the middle class is defined by the government as having suffered substantial tax increases. The vast majority of Canadians will be impacted directly or indirectly by this policy. The new rules, which for the most part take effect immediately, are complex, especially for busy business owners who don't spend a lot of time researching tax legislation. Knowing this is a good idea for business owners and incorporated businesses and professional corporations to have a conversation with their financial and tax planning advisors. Thank you.